Hi, everybody. Welcome to the 7 and 7 show with Zach Ellison. Today we have with us Michael Nix, the Deputy CIO at Pepperdine University. And Michael's really one of the most outside the box, innovative thinkers that I've met in the endowment space. So I'm really happy to have you here today, Michael. And one thing I always think about when I think of you is how you're thinking about where the puck is going rather than where it's been, as Wayne Gretzky would say. So it's always a treat talking to you because I come away with new ideas every time. So before we dig in, tell everybody a little bit about your background and how you got here.
Sure. Thanks, Zach. That's very flattering. I literally can't skate. Uh, so, so I have a fairly unusual background, probably for an investment manager. I started out as a college dropout who just basically didn't find anything in school that I really wanted to do. I left to take some of my retirement up front. I spent a lot of time on the beach. I worked for Bob Dylan, the musician, for a long time as a security guard at his house in Malibu, and just kind of enjoyed my life. Became a scuba instructor. Actually, when I decided to go back to school, I studied marine technology because I knew it would be something that I would be motivated to do and be driven behind. And by the time I finished that, I decided I wanted a more traditional education and went on and finished my bachelor's degree and went into database design, database management is what I sort of found my way into as I started working in the daytime and going to school at night. I ran into someone who really took me under her wing and taught me enough to take over her job when she moved on. So I kind of got into technology. And then when my wife and I decided to start a family, I decided to go back to school. I wanted to learn something about finance because I had entrepreneurial ambitions. Started studying finance at Pepperdine at the graduate school. And as I approached graduation, I thought I wanted to do something in bankruptcy workout, which is sort of like recycling version of entrepreneurship. And I was interviewing with companies, and I went to the university's head of finance and said, I'd love to work anywhere you can use me. I'm happy to work for free. He sent me down to the endowment, and I just started doing what I could to support the team there. And I really fell in love with that stuff, right? And I was talking to actually a distressed manager who I knew socially. And he said, you really ought to consider taking a job in the endowment if they'd hire you instead of going into bankruptcy workout. They actually created a job for me. I started in the endowment. So I've spent my whole career at Pepperdine in the endowment space. It's about 20 years now.
Wow. And, I think one of the things that makes you an exceptional investor is that you have a very diverse background and therefore a diverse perspective, which I think opens up your mind to innovative opportunities that others miss, and you see things that others don't, which makes me wonder, what's something you're thinking about right now that you think the market's missing?
Well, what the market or maybe other investors aren't thinking about that I think is very important is actually the vulnerability of our institutions. I think a lot about how successful Western society in general, American society specifically, has been, and why that has been. And I think a lot of it has to do with these really robust institutions, specifically around our economics, but also around our political life. And I think there's been a real change in tone, at least within my life experience. I don't know. I can't speak for the whole of history, but in my lifetime, there seems to have been a real decline in the respect for institutions and the reverence. It's weird because when I was young, I was irreverent because of my youth, right? And so I didn't really hold that kind of point of view. But as I aged and started to appreciate the world more and had more nuanced views of things, I started to recognize the value of things like, our governmental institutions, our economic institutions. And I think that there's a lot less respect among people who are now my age, right, for those institutions. I think there's a lot more of a focus on a short-term mindset. How do I win the day today? And there's a willingness to sacrifice the institutions. I'm thinking of things like the Fed, the presidency, the Supreme Court, it all very dangerous ground to talk about in modern society, but that's part of it, right? A lot of this intensity has led to, well, I don't care about that institution. But what happens when the shoe's on the other foot, right? And you really need those institutions. So that's something I think about a lot.
So, well, yeah, one of the key themes in the market, of course, is what we're seeing with digital assets, and a big driving force behind that is this intention to disintermediate existing financial institutions and governmental institutions. And what's ironic is now that that space has gotten itself in quite a bit of trouble, and it's clear that it can't really be self-regulated because many of the folks that were running exchanges and funds are now going to jail, and they're outright criminals in many cases. It's clear that now we need the institutions to step in to protect society, essentially. And I just feel like that's kind of ironic, in that what drove the demand for these strategies was this idea that our institutions weren't good enough or they could be better. But ultimately, what we've seen in the digital asset space is they're trying to recreate institutions, just doing it in a way that doesn't make any sense. And now they're having to go to rely on the existing institutions. So you're spot on there. And I definitely see a lot of folks that tend not to support the institutions that got us here. And I think that's a mistake, because ultimately, one of the reasons America, in my opinion, is the best place to live in the world is because of the strength of our institutions. And we've had a lot of trial and error through centuries. Sure. And so we've learned a lot from our mistakes. And we're not perfect. We're far from perfect. But ultimately, we've got a track record of being pretty darn successful relative to everything else that's out there. So yeah, that's
and I would add stable, and stability allows you to plan because you have more solid expectations. So 100%. If you can do better, maybe you don't necessarily need to.
So turning to investing, what are some characteristics that you admire in the world's best investors, and how do you apply what you've learned from them?
So I would say that the characteristic, I don't know, there's a single word for it, but thinking classically rather than in the moment, perhaps, right? Relying on foundational, fundamental ideas rather than analysis of the short-term environment. So kind of thematically related to my desire to see institutions, this is sort of institutional thinking, right? So really, I think of people like maybe Jeremy Grantham, who I'd say what goes up must come down, right? He's sort of known for mean reversion. And that's a sort of classic point of view that really never goes out of style, but frequently gets thrown out, right? When you're in a bubble, no one thinks mean reversion is a thing, right? It's all going to just go forever. Grantham's the kind of guy that'll keep you grounded from that point of view. Warren Buffett, right? Don't invest in stuff you don't understand. He famously talks about not buying Microsoft at the beginning because he didn't understand it. I think that's really sound. Howard Marks, I think he from him, I sort of garnered purchase price matters a lot. And I would say that's the thing I probably run around talking about the most is like, you just can't beat saving money on the purchase because it's baked in returns, right? No matter what happens, it's there. So I think that's sort of the old fashioned ideas, but also an independence of mind, because I sound like I might be going, well, just do the sort of things everybody does. But these are also people who are very independent minded too. So I think that's really key.
Well, a theme you hit on there was this fundamental approach to investing, which never goes out of style. Mm-hmm. And I think when markets get hot, a lot of people tend to disregard fundamentals and they begin trading on momentum and therefore begin speculating in many cases. And I like to think of speculating as very different from investing. And a lot of the themes we saw in 2021, in my opinion, were speculation. And a lot of those investments will lose a ton of their value. And that's playing out now, and I think it'll continue. But those that do well through all types of cycles, whether good or bad, are those that really adhere to the fundamental principles of investing based on value, right? And thinking about the price value relationship that you talked about, that Howard Marks has mentioned many times as being fundamental. I mentioned that in a previous 7 and 7 show, how I think it's something that investors miss all the time. They think about quality of the company or they think about price, but they don't always put the two together and think about how price relates to value. And you can oftentimes buy mediocre assets, but if you get them at the right price, there's actually substantial value there. So it's not just price that matters, it's value that you're getting for that price. And other thing I think about a lot that both Warren Buffett and Howard Marks talk about quite a bit is margin of safety. Mm-hmm. So we know we're going to get things right some of the time, but we're oftentimes going to get things wrong. And when things go wrong, are you protected on the downside? And how are you mitigating risks? Nobody gets anything right 100% of the time. I would basically cuff it that maybe 60% of the time we get it right as professional investors. If you get it right 60% of the time, you're doing quite well, which means you're getting it wrong 40% of the time. So what do you do in that case? And in cases where you got it wrong, you have to make sure that you've got margin of safety on the downside. So yeah, I 100% agree with some of those fundamental principles that you brought up. Last thing I'll mention too is just that I think the market is moving back towards a fundamental back to basics approach. We got very excited and exuberant, irrationally exuberant in my opinion, over the last couple of years. And now people are saying, hey, I'm looking for value. I'm looking for companies that can survive a downturn. And ultimately that always boils back to value investing and the financials of the company and their underlying business model. And it's a lot less about psychology and more about fundamental value. So with that, I wanted to ask, is there any investment advice that you've received that you think every investor should know?
Well, there's one thing that makes the rounds in our office on a regular basis. Somebody will mention it once a month, I feel like. The quote itself is, you don't have to be in Europe, Tommy. It comes from a phone call we had with a hedge fund manager, and he was sharing an anecdote himself, and he was talking about speaking to his mom, and he was all upset about these companies that he had invested in and how hard it was to triangulate them. And she said, you don't have to be in Europe, Tommy. And he uses it and we use it as a reminder that you don't have to do every good idea. You don't have to be everywhere all the time. And in fact, if you are, you're probably overplaying your weak things, your weak ideas, your weaker skills and your weaker opportunities. And if you try to stay focused on the things you do really well, and that's been a theme around here for the last couple of years, I think in particular, where we've really tried to pare down what we're doing. So when we're struggling with something, this manager, I just can't figure out how to categorize them or whatever. And what somebody will inevitably say, well, you don't have to be in Europe, Tommy. And that's our local, inside joke. But the advice is you don't have to do it all. And I think it really helps you be more efficient with your risk taking to realize you can focus on the things you, like Buffett says, understand, right? That you're comfortable with, things that have a margin of safety, right? And you can build the characteristics in your portfolio you want by not always pursuing things that maybe others would encourage you to.
100%. I think of it as high conviction ideas. I used to be a bond trader in my previous life, so to speak. And it was all about high conviction ideas. And diversification is great, of course, and that needs to be a part of every portfolio. But if you're too diversified, it means you're putting some mediocre ideas into your portfolio. Right. And it also means you're just going to have average performance. I mean, if you're fully diversified, by definition, you're going to have the market average return, which might be exciting to some. It's not very exciting to me, nor you, I imagine. And I'm thinking about how to generate alpha consistently. And to do that, you can't do what everybody else is doing. You have to be a bit of a contrarian all the time. And you have to put more risk capital to work on your highest conviction ideas. And sizing them, of course, is a big part of that as well. You might have two good ideas, but if one's a lot better in your view, you got to make sure you size that appropriately, while also considering the downside too, right?
Yeah, sizing is super underappreciated. Good point. Yeah, really, this applies to that as well. Yeah.
I mean, we could get into a lot of stuff about sizing and entry and exit points. I think those are two areas that people miss, and liquidity. I think fundamentally most investors mismanage their liquidity and have too much of it. But most of the time, investors don't need all the liquidity in their portfolio, which actually brings us to the next question, which relates to how you manage an endowment portfolio. because you've been doing this for close to 20 years. And
Wow.
endowments, are very different in terms of how they're managed versus, retail money, for instance. So what are the key principles that you think about when managing Pepperdine's endowment?
Well, I'll start with what you just mentioned, liquidity, right? So for us, liquidity demands are typically pretty mild, right? We're paying out a 5% payout annually of a moving average of historical NAP, which smooths it and allows for better planning. Um, so we do have, some concerns, but 5%, right? I mean, if you're say an endowment with 15% of liquid assets, that's not really an issue, right? And one of the things I remember early in my career talking about, actually, along the lines of liquidity, was the liquidity premium, the illiquidity premium you demand should be dynamic. For your first dollar, your bar should be pretty low, right? Because you're never going to touch your last dollar, or your endowment's gone, um, right? But as you get more and more, you should be more and more picky. Um, so I think what makes endowments unique, timeline, right? We're in theory perpetual, so it's like having a high net worth client who's immortal, and which may happen someday. Um, but it, in theory, we should have the highest risk tolerance. But of course, we're also an institution that's public facing. I think if you had really, really high volatility in your endowment, you'd probably get a lot of bad press. You'd probably be accused of mismanaging the endowment, and there'd probably be a lot of pressure to calm down. Um, and in fact, with endowments, I think probably the biggest hazard you have to navigate is the the whole issue around peers, because you have multiple issues, right? For one, I know my initial reaction as a young person was, I don't care what anyone else is doing. We need to do what's right for us, which is a great way to think, except that the university competes with other universities. And so, I was told the cautionary tale about a school I won't name that got out of the equity market in the late 80s and didn't get back in until the early 2000s. Um, their endowment didn't grow during that period, and their peers' endowments did. So they now have a much smaller endowment than the rivals they were tied with in the 80s. And I don't know the details, so I'm not going to name them. But that's always in the back of my mind, right? If you're out of step, wrong alone, right? The classic idea of being wrong alone. It's embarrassing for the school, but it's also a competitive disadvantage. So I think having to think about what your peers are doing is something that we have begrudgingly absorbed. I don't think any of us want to be like that. I think we're all very independent minded, but I think we all recognize we're all grown ups, and we recognize the need that we're constrained a little bit within our endowment, within our options. So I think that's another thing that we have to manage. And I'd say there are some things that are similar, right? Like to say being an RIA, where we have clients who are human beings who are not investment professionals, and we have to make sure we're communicating to them really well, really getting ideas across, but also preparing their minds for eventualities, and understanding what the strategy is and making sure we have buy-in every step of the way, and that we constantly maintain that, because there's always turnover at an institution as well. There's turnover in the staff, and there's turnover in the governance side as well.
Yeah, great points. I think a lot of people forget that you've got a lot of very diverse stakeholders, because you've got students, you've got faculty, you've got alumni, and a lot of them have very different views and might not even want you investing in certain areas of the market. Right. We see that at a lot of universities where students or alumni might say, hey, we're opposed to something for reasons that aren't necessarily economic. It could be related to other factors. And so you've got to manage quite a lot of competing interests and divergent views.
Absolutely.
Tough. So what keeps you up at night in terms of investment risks?
Well, that to some degree, but I think, we have a good relationship even with the students, we speak with the students. And so, I think we've got I think we can sleep at night in terms of our preparedness there. I think the thing that keeps me up at night is being right and losing. The idea, The analogy I would use is climbing like Everest, where after a certain point, a lot of it's out of your control, no matter how good a climber you are, how prepared you are, right? You're up in the death zone. Maybe that's not a great analogy, but the idea is that we don't control everything. It's more poker than chess, or maybe in my case, roulette and checkers are the better analogy. But there are things we can't. I think poker is probably the better analogy, right? You have the randomness of the cards you get, but you also have how you play them. And I think that investing is the same, right? You have an element of randomness, and you have an element of planning, reaction, preparation. But I would be lying if I didn't say sometimes I get a little sad when I think about all the risks that I've defended against that ended up just being costs, right? Right? Because they didn't happen, especially having a career that spans this century, right? When it looks like things are going to fall apart, we've had massive intervention, right? That's rallied the market. So really, those who were defensive didn't win that much, even when things went badly. So there's a little bit of a temptation to abandon risk management and chase returns. That's not something we're going to do. It's in none of our nature here. But I do worry that foregone returns are losses in a way too, right? And so I worry that I maybe don't deliver the institution enough out of an abundance of caution. So I'd really try to balance those things up so I can sleep at night.
And that makes me think about this idea of investing in innovation and how that brings opportunity, but it also brings risks. Because if you're too early, sometimes that means you're just wrong, right? And I often think about that idea that being too early, it means you're wrong. But to outperform over the longer term, you're going to have to take risk on the margin in terms of your thinking, not just your thinking, but where you're actually putting money to work. Which brings me to the next question, which is, how do you think about alternative assets, particularly assets that are relatively new to some investors, whether that's venture capital or venture debt or other strategies that are emerging? How do you think about those in the portfolio context in terms of optimizing your upside, but also having that margin of safety?
So I would say the first thing I think about, first of all, I totally agree with you that we need those things, that we need to seek out opportunities. It's no risk, no reward. You have to take chances in this business. We're not in a risk minimizing business, right? We're in a risk trade-off business. So a lot of that is having a broad perspective and being a decent futurist on some level. But the truth is that we try to defend against our own perspective as well. We really, really genuinely believe that we will make mistakes on forecasting, and that is not our route to success. We look for good ideas and good partners in those ideas. And sometimes they're new. I believe you've talked with one of your guests before about the best returns from a manager typically are when they're new. But so are but those are also the managers that flame out, right? That don't stick around long enough to be old. And we've had both of those things. We've had benefits from being with new managers, and we've had things that fell apart. And we really try to debrief our team on what went right, what went wrong, so that we can get better at it. I would say, for example, with one manager that we had that went out of business, it was a great portfolio construction choice. It's a huge win on portfolio construction, but it was a bad manager choice, bad partner choice. And that was really informative, because I really believe that those are the two big jobs I have, right? Is finding great partners and putting them together in a way that they're struggling at different times, right? And so that my dream is a steady return, right, of very aggressive managers. So getting back to risk, we actually we try to be aggressive and then diversify away a lot of that risk. And so new managers often tend to be more concentrated positions, which means actually more idiosyncratic risk, typically, which we like, right? Especially if it's something that we really understand and can evaluate. So like if it's, say, a private equity co-invest in a space that we're really familiar with. Those things excite us because it's this project's success or failure that matters, not everyone else's opinion about this project success or failure, which the public markets tend to reflect, right? Public opinion rather than actual results. And so we can get closer to actual results, and that means more diversification.
When we were talking offline, you mentioned how you have very little corporate bond exposure. I don't know if you're allowed to talk about that, but if you are, I'd love to hear your thinking around why you're underweight corporates and also looking at private credit or other income generating strategies.
Yeah. So it's not a tactical decision. It's more I think it evolved in the very fullness of my career. It's really not been an area of responsibility for me other than very early when I was reporting on everything. I think we simply don't feel we have a ton of expertise there. And so we've had plenty of other things to pursue, and we've chosen to do that and remove that factor from consideration. Then it's just something we don't have to worry about. I think we're at a point now where we really want to reverse that and turn our focus to corporates, probably more private debt, to be honest. I think that's something that suits us better. I just think it's a factor that we felt like we didn't really need to build into our portfolio. And if we didn't really have any special ways to triangulate on it, why be in Europe, right? Why do that?
Well, it's funny. I traded corporate bonds and managed large bond portfolios for years. And right now, over this next part of the cycle, I think of bonds as return-free risk, right? Corporate bonds.
Yeah.
I mean, literally, you have risk in both interest rate risk and credit spread risk, and the likely returns are going to be below zero over the next couple of years, in my base case view. So that's kind of the running joke. Return-free risk, not risk-free return.
Yeah.
So, Michael, we're almost out of time. I wanted to get your parting thoughts on any key themes over the next part of the cycle that you want to leave investors with.
Well, I think it's connected to your idea of return-free risk. And one of my favorite guys to read, who's got a reputation as a perma bear, but I just think he's a really bright independent banker. His name's John Hussman Funds. You may have heard of him. I think he gets mocked a lot because he seems to always be bearish. And he talks about return-free risk in equity markets. And one of the things I've learned in time is that even if I think markets are overvalued, that doesn't mean anything has to happen anytime soon. And I could drive myself nuts trying to play that as if it were about to happen. So through that growing process, one of the things that we've developed as a tactic here is to have real plans for if things happen. Instead of saying this is going to happen and we're going to position ourselves for it, say, look, we think there's a big risk here that markets are priced to return nothing for a decade. If that's real, and how do we handle that? What is our plan? Then there are different ways that can play out. It could be mediocrity for a decade, but it could also be the crash and a rebound and things like that. And so we really have formal playbooks for those scenarios. We've literally spelled the steps out to do it. We had good fortune with that in 2020. We executed on a move to move a bunch of money into the equity markets when they pulled back in 2020, and we almost bottom ticked it, which was luck, not skill. So that was drawing well in poker, but playing the hand correctly. But really following the model, following our plan, and doing what we said we'd do. So that would be the thing I would say going forward is think about the things you think might happen, and it could be something completely different. And what's your plan for doing and having a plan? I think that's instead of being reactive. Yeah.
Well, Mike Tyson said everybody's got a plan until they get punched in the face. You guys have a plan even if you get punched in the face.
Yeah. Equity markets down 50% is very analogous to getting punched in the face by Mike Tyson.
Michael, it's been great having you. I always learn something talking to you. Really appreciate you coming on today. And thanks everybody for listening to the 7 and 7 show with Zach Ellison.